just in time for your weekly most comprehensive look at the world of business and economics. Welcome to Business Redefined. Tonight we are focusing on Absa, which is observing 1 year since the rebrand, and we are privileged to have Mr. Jeremy Awori, the Chief Executive Officer. Welcome on set.
Thank you. Thank you.
I was combing through the annual report for 2019, and one of the things I was looking for is the indication as to what happened to the provision for reimbursement of the transition costs which were incurred by Absa Africa. I didn't see this. Just explain to us what could have happened.
Yeah, basically what we didn't want was the minority shareholders to experience either a drop in dividends, or to impact the capital position of the bank. So the majority shareholder, Absa Group, basically waived its right to take out its portion of the dividends, which was to the tune of about 1.2 billion. So it left those in retained earnings. And those are reflected in the balance sheet of the bank as at the end of 2019.
The agenda, if I read the report right, is targeting a 50% cost-to-income ratio in the medium term. Yeah. In an environment where incomes are significantly subdued in light of the pandemic, how do you see this going forward for the bank?
Yeah, I mean, I think directionally it still has to be in focus. We just have to adapt to the environment. So when you look at a cost-to-income ratio, there's two elements. There's the cost and then there's the income. So when the income is subdued, obviously your ratio is likely to start picking up. Yeah. So what we have focused in on is two aspects. Where can we safely grow given the environment? Yeah. Because at the end of the day, we're still custodians of people's deposits. We want to lend them properly and give shareholders a return. We continue to invest in automation, digitization, and efficiency. So we have got significant initiatives that I can say are bearing a lot of fruit on the cost side. I would arguably say we're probably one of the best banks at managing our costs, in the market. So that will come out in, when we release our results. So we'll continue to focus on both aspects, managing costs and efficiency and waste as effectively as we can. Invest in digital automation and digitization because that also is attractive to customers' needs, which will grow our income. And then we're also getting into new businesses which have good returns that we were not in before, which again will boost our balance sheet and our income.
I like what you've said, we can safely grow. Let's talk about asset quality, and why that is important is because in light of the risks precipitated by COVID-19, we have the latest data indicating that more than half of the banking sector loan book is now restructured. NPLs are clearly ticking up. Does this trend bother you? Do you feel it is a challenge on the overall asset quality and stability of the sector?
Yeah, I mean, I don't think it's unexpected, the fact that, when so many people have lost jobs, tens of thousands, hundreds of thousands of people have lost jobs, not just here, but everywhere in the world. If you've lost your job, it becomes very difficult for you to continue your repayments. If your business is struggling because of some of the containment measures that have affected it, or people's ability to buy your product. So that's why I said we worked with our customers to try and manage through this. So I don't think it's altogether surprising that we're seeing an uptick in NPLs. We are no different. Our NPL ratio is typically much lower than the industry because we're fairly prudent around where we lend as well. I think what is real is just the level of impairments and provisions that banks have to make, which are required by regulation around those who have defaulted or may default. Because with IFRS 9 standards, you've also got to take a forward-looking view as to what provisions should you take in events of certain stress scenarios. So we've run a lot of stress test scenarios. We have analyzed our customers by segments. So we see the areas where we need to provide. We're very conservative in our view. So where we think there's strain and an appropriate provision needs to be made, we make it. While we work with customers, and hopefully they come back on stream. And if they come back on stream, then we can release that provision back later.
Looking at the banking sector results for the periods last year up to Q3, I noticed some very aggressive provisioning from Tier 1 banks, not quite as much from the bottom tiers. Would you say the level of provisioning in your assessment is commensurate to the risks we are now facing across the sector, not just Absa?
Yeah, I mean, it's very difficult to comment on the entire industry. I mean, that question may be better posed to the central bank, who has a more broad view of all the banks and their models, because we have quite advanced models around impairment, where we should provide, how much to provide, in which areas, etc. I think if I observe last year as an example, I think initially people thought COVID would be a quick 1, 2, 3 month thing, and they didn't really provide. As Absa, what we did is we did a lot of stress testing, we did a lot of scenario planning, and we looked for early signs of stress on our clients, and then using modeling techniques, we then decided which ones to make provisions for. So we were in our view very conservative. I think as the year went on, more institutions started seeing this is not going to just be a flash in the pan, couple of months thing, and started seeing more stress. Yeah, so they started increasing their provisions and their bad debts and their non-performing loans. So I wouldn't be surprised if in the last quarter, as we get to the auditable period, that's the other factor. During the year, the auditors don't have to look at the books and they don't have to necessarily vet the model that you're applying. But when you come to the end of the year, in addition to the regulator, the auditors have to use IFRS 9 principles and actually ask you, so why did you arrive at this? In this case, this customer is stressed. Did you provide adequately or not? And those conversations have to happen between the auditors and the management. So I think we may see some changes in some of the banks, up or down, because we're also seeing the economy starting to pick up. So it may be difficult to tell which parts have gone up, which parts have come down. But I think we can expect non-performing loans to be here for a little while and to be elevated. And we're hoping if this year the economy comes back, that they'll get back on course and people's spending will, within businesses in general, will improve, thereby boosting the economy.
One key issue around this environment right now, and really from the rate cap regime, was about the revenue diversification. And when you look at your revenue streams away from interest income, how comfortable would you say you are as a bank, especially when you look at things like FX income, the fixed income trading book as well?
Yeah, I mean, that's part of our strategy, is to diversify our income streams, not just between interest income and fee income, but also within those areas. Yeah, so we're investing significantly in new businesses. So we've started a brokerage business. We've got our licenses to run an asset management business. We've got a bank assurance business, and then we got into the whole world of sort of digital online with our Timiza platform. So we've got a lot of new business opportunities. I think there are areas where we feel we've got disproportionate growth opportunities. So I think SME and business banking is one, bank assurance is another one. The two businesses I've just talked about, asset management and brokerage. I think the mortgage business is another one. And then we have all our core businesses, like our retail bank is growing very strongly and doing well. Our corporate bank is doing well. We're on the foreign exchange and market side, which includes the fixed income trading. We're one of the leaders in this business, in this market, and we have all the solutions from hedging solutions, risk management solutions that are also growing, that will help us on this side. So we see quite a diverse range of income streams, and that's what's exciting. So as part of the strategy was specifically to diversify that, and I think we've done that over the last 5 years.
Speaking about the effort towards consolidating your footprint in the institutional banking space around wealth management, one of the concerns I had when you were unveiling the Absa Asset Management was that you were venturing into the space at a time when the investable opportunities in the capital markets were clearly being eroded for obvious reasons. Whether you look at the fixed income, the yield curve was coming down. If you look at the stocks, prices were tumbling. How is its performance thus far?
Yeah, it's still a very new business. We had to make sure that we got all the regulatory approvals. But an asset management business has to work through the cycles, right? It has to look at different asset classes. So whether prices are going up or down doesn't mean that you don't invest. So I think obviously we work with our clients as they look at what their risk profiles are, what their return expectations are, and the time horizons that they're working to. So that is an interesting business. I also think with the asset management business, you've got institutional clients and then you've got retail clients. I think there's a significant opportunity for both, but in particular, how do we come up with retail asset management products that are affordable to more people? I think the good thing with that is if we're able to mobilize these monies, we can use it to support companies that want to list, for example, companies that need investments. We can be a better provider within an ecosystem of those funds. And then we've got the institutions, the pension funds, whether they be NSSF or whether they be private pension funds, family offices who might want to look at new investment opportunities. And then there's local, and then there's foreign also. Some people want to invest in the global markets, and we'll offer them those opportunities. So I think it's an exciting space. I think this year is going to be our first full year of operating as an asset management business. So I'm excited about it.
Jeremy, you've recurrently mentioned about the aspect of giving a return to your shareholders. And I'd be remiss if I don't ask you this. A number of banks and a number of companies are in a capital preservation standpoint because of COVID-19. Is there a dividend anticipated in light of the business environment?
You know better than many that I can't comment about, given we're in a closed period, about our full year, our full year financials. But you've hit it on the head. At the end of the day, it's really around capital preservation, making sure your bank is on a solid footing for the next period. So it wouldn't be altogether unexpected to see banks saying, look, we want to preserve capital. After all, we've seen a significant drop in earnings. So depending on individual banks' positions, they have taken that view. We took a view at the half year that we said, look, normally we pay an interim dividend, but because of the uncertainty, we said we're going to hold it back. And I guess the discussions will be with the board to decide based on the current economic environment before we release the results, whether that dividend is better held back to invest in the future to make sure the bank is on a solid footing. Because the last thing you'd want to do, pay out a dividend, your capital ratios come under pressure, and then you're having to go back to now start looking for further capital injections. And these are discussions which we have with our shareholders. Our majority shareholder is patient. They're a long-term shareholder. So if they feel, look, that it's more prudent for us to retain those earnings, they will retain those earnings. And obviously for the minorities, we'll have the discussions with them.
One of the key concerns out here is that in light of the risks in the environment, there isn't much clarity as to how we are pricing risks as banks, especially because we came from the rate cap regime and we haven't had much communication coming thus far. How is Absa handling this?
Yeah, we do a lot of modeling of our business and of our customers and the risks that we're willing to take and how to price those risks. So that's inherent in the way we do business and inherent in the way we set our risk appetite within the context of which we're operating. One of the things we are doing, and I think you've heard about it, is as an industry we're trying to move to risk-based pricing, being supported by the Central Bank of Kenya, led by the governor. So I think ourselves and other banks have put forward our proposals for risk-based pricing. And that simply just means that we want to be able to price risks better, like you alluded to, for different clients. It's not everybody has the same credit profile. And I think the problem in the past was that because we couldn't differentiate the credit profiles, there's a tendency to just go to price to the highest to cover the highest risk in a way. So in a way, good borrowers were not able to get the pricing that would reflect their credit risk. So I think we're just now waiting for the central bank. I believe they're in the final stages of reviewing and approving each individual bank's proposals and the rationale behind it. And then we look forward to that, because what it does is there may be certain clients or segments that within the current pricing mechanisms do not make sense and cannot give us a return as a bank. But with slight adjustments in the price, they may bring them into a space where we can give a decent return on what we call risk-weighted assets. Yeah, because at the end of the day, we are a business. We have to give returns to our shareholders. Yeah, so we're looking forward to that, because it will allow people to be rewarded for their good practices and get more affordable pricing, and then also bring in a whole new sector of clients who may be not able to get into formal borrowing with banks today, and having to use other means of securing funding, which may be even more expensive than what banks can do.
One of the challenges that many entities will tell you when they're going through M&As and also rebranding is the stickiness of the consumer. And I remember one of the major players in the banking sector had acquired a smaller bank. They thought they would integrate it. A few months down the line, they were like, no, we will not integrate. Let's actually just retain it as it was. Have you faced these challenges of stickiness from your consumers when you're rebranding?
No, absolutely not. I mean, our customers have stood by us in ways that we could just never imagine. I mean, obviously, when we were considering this, it's obviously a concern as a management team. Barclays had been here as a brand for more than 100 years, and then we're introducing a new brand to them. But our customers were extremely loyal. We kept them up to date with what we were doing. We spent probably 2 years before we actually transitioned explaining who Absa was, explaining what Absa wants to do, the products and services in relation to them, how we fit in terms of their financial needs. And they stuck by us and gave us even more business. Our business has been growing. We have hardly seen any attrition at all. So I think that's testimony to the colleagues within the bank. Because at the end of the day, those colleagues were the same colleagues who were serving them under Barclays and are serving them now. And I think the management team has been consistent, the board has been consistent, and we're proud that we managed to do it safely with minimal inconvenience, we believe, to our customers, and that's coming through on our customer satisfaction measures that they're seeing. They tell us things are improving. We still, in my opinion, have much more to do, but that's just being part of business, keeping yourself relevant and improving.
So when you look at the trend line of growth of something like your deposits, for instance, you wouldn't say, barring COVID-19, there was no indication that rebrand was having an impact?
No, there wasn't an impact. In fact, we've actually seen, funnily enough, many customers and people coming to us to say, I actually want to be part of Absa and be banking with you. And there are others who had business with us but have brought more business to us, rather than the contrary, where it was maybe going to other banks. And for that, we thank them.
The credit guarantee scheme, to the best of my knowledge, is now in the process of the rollout, the final kicks, really. How much of a game changer do you think this will be?
Yeah, we're really hoping that it will support lending to SMEs and gather pace. So we've worked very closely, and we're one of the banks participating in that scheme. So we're working as a sector with the participants. We're working closely with the central bank, and then we're also working with Kenya National Chamber of Commerce and others who have businesses that would qualify for those schemes. So I'm really hoping it becomes a big success, and that we then can put more funding in there and be able to lend to more SMEs, because I just think they're the mainstay of the economy. If we have a healthy SME sector, I think the country and economy will grow. So it's early stages. Banks are very committed, and let's watch this space. I think this will be the first full year that we will see, and we'll be able to take stock at points along the line to see where do we need to tweak, what's working, what's not working, how do we improve it. So I think let's watch this space, and I think it will be quite encouraging.
Lending to SMEs remains a sticky issue, especially because of the level of impairment that COVID-19 has subjected them to, given the level of vulnerabilities they face. From the Absa standpoint, how are you assessing SMEs and accelerating credit to them at the same time exercising that level of caution?
Yeah, I mean, what we do is we look at risk and return. As I say, we've got a responsibility to our shareholders and to depositors. And we have very clear risk frameworks around where we believe we can safely lend and the areas where we might be a bit more tentative, just because the macros don't support it. So we make those assessments. And I think lending to SMEs is always a challenge. It's more of a challenge than maybe lending to large corporates who have big finance functions. They're able to keep their books fully up to date. When you're dealing with a smaller enterprise, a mamamboga or a sole proprietor, you obviously have to assess their business slightly differently. We have built and refined our lending models to make those credit risk decisions, and we believe they're working well. So we're lending, we're finding clients to lend. We're finding clients who are at other banks wanting to come to us because they see the value that we offer holistically. And we're encouraged. I mean, COVID will at some point end, whether it's the vaccine comes in or herd immunity comes in, or it's not going to be with us forever. And we're seeing through that. So we have a very long-term strategy, and we will play and invest to deliver that strategy.
Within the competitive landscape, the rebrand was happening at a time when there was a lot of consolidation happening in the banking sphere, whether it was acquisitions, etc. How has it been for you for the last 12 months?
Yeah, the last 12 months has been very exciting and quite challenging just due to the operating environment. I mean, we're operating in a pandemic. I mean, what was interesting for us is this time last year, we had just launched the brand with a lot of pomp and celebration and excitement, and then within a month, we were facing a pandemic the likes of which we haven't faced in the last 100 years. So we had to pivot our business very quickly. Most importantly, one of the things that we did is we provided loan relief and loan repayment moratoriums to almost 60,000 customers worth 62 billion. And I think that really, in my opinion, helped those companies and individuals just weather the storm. Beyond that, I think it's just been how we grow and execute our strategy within the confines of the macroeconomic environment, which was difficult. But our strategy is very much on course.
Right, and that point takes us to the close of our conversation with Jeremy Awori, the Chief Executive Officer at Absa Kenya.